I've been sitting here for, what, like 20 minutes, just staring at this chart on the screen before we even hit record. It's the S&P 500 futures, last Tuesday's morning session. And I have to be honest with you, and I think a lot of people listening probably feel this exact way. It just looks like, well, it looks like absolute chaos.
It's just a mess of red and green bars to most people.
It really is. I'm looking at this specific, this chop around 9 a.m.
Yeah.
It rips up, it crashes down, it just wiggles sideways. It feels completely random, like noise. And then suddenly, out of nowhere, boom, this massive clean spike straight up. And to me, sitting here, that spike feels like pure luck. Or maybe there was some news I missed. But mostly, it just feels like part of the chaos. And yet you're sitting there with that calm look on your face that tells me I'm missing the entire point.
You're seeing the illusion? That's the very first hurdle for every trader. It's designed to look like chaos. It's designed to look like noise to the untrained eye, because if it was perfectly predictable to everyone, the market just wouldn't function. But if you strip away the candles for a second and you just look at the logic underneath, what you're seeing isn't random at all. It is highly, highly engineered precision. That chop you're so frustrated by, that's not indecision. That is preparation.
Preparation for what?
For delivery. See, most people, and this is, how we're all taught in Econ 101, we look at a chart and we see a battle, buyers versus sellers, the bulls versus the bears. It's this epic tug of war, right?
And whoever yells the loudest or, throws the most money at it wins the candle. Supply and demand.
Supply and demand.
The invisible hand.
If more people buy Apple stock, it goes up. If everyone panics and sells, it goes down. It seems pretty straightforward.
Exactly. And that is the retail view. That is the view that keeps you trapped in what I call the pattern recognition cycle. You see a shape, you buy, it fails, and you blame the market or you blame yourself for not seeing the pattern clearly enough.
I've been there many times. Yeah. We all have. But what we're going to deep dive into today, this ICT 2022 mentorship framework, it completely flips that entire worldview on its head. It argues that the market is not a democracy, it's a matrix. It's not driven by random buying and selling pressure. It's driven by an algorithm.
An algorithm. Okay, hold on. When you say algorithm, my mind immediately goes to high-frequency trading bots skimming for pennies. Or maybe those black boxes at big quant funds. Is that what you mean? Or are you talking about something big?
Much, much bigger. We're not talking about HFT bots that are just, scalping tick differences. We are talking about the engine itself. The source material refers to it as the IPDA, the Interbank Price Delivery Algorithm.
IPDA, Interbank Price Delivery Algorithm.
Correct. And once you can accept that one premise, that price is being actively delivered to specific levels rather than just drifting there based on public sentiment, everything changes.
Yes, so?
Well, you stop looking for a head and shoulders or a bull flag just for the sake of the shape. You start looking for the narrative. You start asking a different question. What is the algorithm trying to achieve right now?
That is a massive claim, though. You're essentially saying the market is rigged, or at least it's orchestrated.
Rigged is a loaded word. It implies it's unfair in a broken way, or that it's malicious. I prefer engineered. Engineered means it's efficient. It has a job to do. Think of it less like a casino where the house is trying to cheat you, and more like a delivery truck. It has packages to pick up and packages to drop off.
And our mission for this deep dive is to figure out the route of that truck.
That's the perfect analogy. We are going to break down this ICT 2022 model step by step, and I want to make a promise to you listening right now. By the time we finish this conversation, you aren't just going to know where to potentially enter a trade. You're going to understand the choreography, the when and the why.
I like that word, choreography.
Yeah.
Because looking at this chart now, with you saying that, I want to see the dance. Yeah. But I have to throw out the reality check right at the top here. We are digging through hours of lectures, notes, and some very dense theory. This isn't some get-rich-quick magic button, is it?
Not even close. And the source material is brutal on this point. This isn't for the gambler. This requires what the mentor calls a submission to time and price. It requires you to completely destroy your old perspective on how assets are repriced. If you're looking for a signal service, this isn't for you. If you're looking to understand the mechanics of the machine, stay with us.
Okay, let's unpack this. Section 1, the philosophy. Because this is the hurdle I think most people, myself included, trip over immediately. We are taught from day one that markets move because of buying and selling pressure. If everyone runs out and buys the S&P goes up. But you're telling me, based on this framework, that's a myth.
In the context of the IPDA, yes, that is the retail myth. The framework posits that buying and selling pressure from you, me, and even fairly large hedge funds has essentially Zero effect on where the algorithm intends to take the price.
Zero effect. That is incredibly hard to swallow. You're saying if a million retail traders all click buy at the same time, price could still go down.
If the algorithm needs to reprice lower to find liquidity first, absolutely, yes. Think of it this way. The market seeks efficiency. It's not a democracy where every dollar gets a vote. It's a mechanism, and it's managed by the central banks and the large institutions. And according to this theory, this mechanism seeks to do only two specific things. If you can memorize these two things, you're halfway there.
Okay, hit me with them.
1, seek liquidity. 2, rebalance imbalances.
Seek liquidity and rebalance imbalances. That's the entire directive, the whole source code.
That's the source code. Everything else, the news, the geopolitics, the earnings reports, all of that is just catalyst. It's the excuse to speed up the process of doing those two things.
Okay, let's start with the first one. Seek liquidity. When you say liquidity, I immediately think of cash, like liquid assets.
In trading terms, I want you to think of stop losses.
Stop losses. Okay, explain that connection.
The market is a liquidity engine. It needs fuel to move. Now imagine you are smart money, a massive bank or an institution. You need to buy, say, $500 million worth of Eurodollar. You can't just click buy at the current market price.
Right, because your order is way too big. You'd chew through all the available sellers at the current price, and you just push the price up against yourself before you even got your full order filled.
You'd get terrible pricing. It's called slippage. You need someone to sell to you. You need a massive pile of sell orders sitting there just waiting to be triggered so you can absorb them without moving the price too much. So where can a bank find a massive, predictable pile of sell orders?
Below the lows, where all the retail traders put their stop losses.
Bingo. If you are long, if you bought the market expecting it to go up, your protective stop loss is a sell order. You're telling your broker, if it drops to this price, sell my position to stop the pain. So if the algorithm wants to facilitate a large buy for smart money, it will deliberately drive the price down below a clear and obvious old low specifically to trigger all those sell stops.
It's literally hunting them.
It's harvesting them. That drop triggers a flood of market sell orders. And who is waiting on the other side of that sell flood? The smart money. They are the ones buying from your stop loss. That is why price moves there. It is not random. It is seeking the fuel.
That is both terrifying and makes a ton of sense.
Yeah.
It explains that feeling every single trader has had. You know the one where you set your stop, you get stopped out by exactly one tick, and then the minute you're out, price reverses and goes exactly where you thought it was going to go in the first place.
Precisely. And you sit there thinking, they are watching me. My broker is hunting my stop. But it's not personal. It's structural. You were probably right about the direction, but you were wrong about the narrative. You placed your stop where the liquidity was. You became the fuel.
You became the fuel. That's a bumper sticker for day traders right there.
Okay.
Wow. Okay, so that's seeking liquidity. What about the second directive, rebalancing imbalances?
This gets to the concept of fair value. We'll get into the technicals of what's called a fair value gap or FVG later, but just conceptually, the algorithm wants to be efficient. If price shoots up too fast, like that big spike you mentioned at the beginning, it leaves gaps in the data.
Like if you're painting a wall with a roller and you move too fast, you leave streaks.
That is a perfect analogy. You leave streaks, unpainted spots. In the market, a massive, explosive green candle means price was only offered to buyers. Sellers didn't really get a chance to participate at those specific price levels. The market considers that inefficient. So the algorithm has a directive to come back down, to retrace and fill in the streaks before it can continue on its way.
So it's constantly expanding to grab liquidity and then contracting to fill in those gaps.
Expanding and contracting, like a lung. That's the rhythm.
So narrative over setup. That's a phrase that keeps popping up in the research for this. What does that actually mean in practice for someone listening right now?
It means you don't just look at a chart and say, oh, that looks like a bull flag, I'll buy. That's a setup without a narrative. A narrative asks the question, where is the money? It looks at the chart and asks, where are the retail stop losses clustered right now? Is the market trying to trap shorts, or is it trying to trap longs? If you can't answer where the money is, you don't have a narrative.
And if you don't have a narrative?
You are the liquidity. It's the old poker saying, right? If you've been at the table for half an hour and you still don't know who the sucker is.
It's you.
Got it.
Okay, so we have the intent. The market wants to steal our stops and fill its gaps. But the sources emphasize that knowing what keeps the market moving isn't enough. You have to know when it moves. This brings us to section 2. Time. Time, then price.
This is the primary filter, and honestly, it's the one most people ignore because they want action. They want to trade whenever they have a free hour on their lunch break, after work, whenever they feel like it. But the algorithm operates on a schedule.
I was looking at the notes, and there was this example of a perfect-looking setup, I mean, a textbook, beautiful structure, that just completely failed. And the mentor's response was simply, what time did this happen?
Right. A price level is absolutely useless until time is considered. You can have the most perfect support level, the most obvious gap, but if you are trying to trade it at 12:30 p.m. Eastern during the lunch lull, the algorithm isn't in spooling mode. It's not active, it's just meandering. You're basically just flipping a coin at that point.
So let's talk about these specific windows, the kill zones, which, again, adds to that whole predatory vibe we've got going on here.
It's an aggressive term because that's where the hunt happens. We have three main ones mentioned in the 2022 framework. First, you have the London Open. That's from 2:00 a.m. to 5:00 a.m. Eastern Standard Time.
Right, for the night owls or our listeners in Europe. What's the signature move there? What happens in London?
The signature of the London session is critical. It often creates either the high of the day or the low of the day. And it introduces a very specific concept called the Judas Swing.
The Judas Swing, I love the terminology here. It's very biblical. Betrayal.
It is a betrayal. Think about it. The day opens, the London session kicks off, price starts racing aggressively upwards. Retail traders see this breakout and they think, okay, the trend is up, London is buying everything, I got to get in. So they jumped in long.
And then what happens?
And then the rug pull, that initial move up, it was a fake out. It was the Judas Swing designed specifically to trap buyers high, to accumulate their long orders, and then reverse and plummet for the rest of the day. It leads you in just to betray you. If you don't know the Judas Swing exists, you get slaughtered in the London session.
So London often sets the trap. Then we get to the main event. For us in the States anyway, New York.
The New York AM session, that's 8:30 a.m. to 11:00 a.m. Eastern. This is the heavyweight champion. This is where you get the overlap with London closing. You get all the major U.S. news releases. You get extreme volatility. Specifically, 8:30 a.m. is highlighted as a key injection point. If you're trading indices like the S&P 500 or the NASDAQ, this is your arena.
And then things quiet down for lunch, and then there's the afternoon session.
The New York PM session. That's from 1:30 p.m. to 4:00 p.m. This one is interesting because usually around lunch, say from noon to 1:00 p.m., the algorithm goes into a holding pattern. The PM session will often seek liquidity that's built up around that lunch hour range and then either continue the trend from the morning or set up a complete reversal.
But the key takeaway here is, if you aren't in one of these kill zones, you probably shouldn't be clicking buttons.
You should be sitting on your hands. It's about knowing the schedule of the machine. I mean, why would you try to rob a bank when the vault is locked on a timer? You wait for the timed lock to open. And speaking of timing, we have to mention the true day open. In this framework, the trading day doesn't start when the sun comes up. It starts at midnight, New York time.
Midnight, 00.000 EST. Why is that specific time so important?
This is a crucial reference point for the algorithm. It measures everything relative to that midnight opening price. Think of it as the anchor for the entire day. If we are trading above the midnight opening price, we are said to be in a premium.
Premium meaning expensive.
Yes. And generally, the algorithm wants to sell from a premium. Conversely, if we are trading below the midnight price, we're in a discount. We're cheap. And the algorithm wants to buy from a discount.
That is such a simple but powerful heuristic. Just asking, am I above or below midnight? It instantly gives you a directional filter. If I'm looking for long trades, but we're way, way above the midnight price.
When you are trying to buy in a premium, you're buying expensive, you're swimming upstream, the probabilities are stacked against you. You want to buy when price is cheap relative to the new day. It forces you to stop chasing price that has already run away from you.
Okay, this is great. So we have the intent, which is liquidity imbalance, and we have the time, which is the kill zones. Now we need to find the fuel. We touched on this with stop losses, but let's drill down. Liquidity pools, buy side and sell side.
This is all about visualizing the chart like an X-ray. When you look at an old high, what traders call a swing high, what do you see?
I see a peak, a little mountaintop. Resistance, I guess.
The algorithm sees a pool of buy stops. That is buy-side liquidity, or BSL. Think about it. Anyone who sold short on the way down from that peak, where is their protective stop loss?
Right above the peak.
Yeah.
To protect their short position.
And a protective stop loss on a short position is a buy order. So that old high is like a magnet. If the algorithm wants to generate buying interest or find liquidity to sell into, it will run price up through that old high. It triggers all those buy stops, converting them into market buy orders, and the smart money is on the other side, selling into that flood of buying.
It's so counterintuitive. Price goes up, hits the high, everyone gets excited and buys the breakout. And that's the exact moment that smart money is selling to them.
Exactly. And that is why breakouts fail so often. And the reverse is true for the lows. Obvious swing lows are sell-side liquidity, or SSL. They are pools of sell stops resting just below. The market runs down, triggers the sell stops, providing the liquidity for smart money to go long.
This leads us directly to the concept of the sweep or the raid.
Mhm.
This is the visual that really helps in identifying the setup, right?
Yes. A sweep, or a purge, as it's sometimes called, is when price just pierces that old higher low, but it doesn't stay there. It grabs the orders and then immediately rejects and reverses. To a retail trader, it looks like a breakout. Oh, we broke resistance. We're going to the moon. And so they buy the breakout.
And then 2 minutes later, they're completely underwater.
Because it wasn't a breakout, it was a raid. The banks needed those buy orders to fill their massive short positions. They swept the liquidity, got their fills, and now the price is going to reverse hard.
There's this rhythm mentioned in the notes, external to internal and back to external.
Mm-hmm.
Can you visualize that for us? What does that mean?
Sure. Think of external liquidity as those swing highs and lows on the outer edges of the trading range, the peaks and valleys. That's the boundary of the playground. Think of internal liquidity as those fair value gaps we mentioned, the inefficiencies that are inside the current trading range.
Okay, so external is the edges, internal is the middle.
Right. The market is like a pendulum. It swings out to the external liquidity, say it sweeps a high, then it swings back to the internal to fill a gap, then it swings all the way out to the other side to take the external liquidity on the low side. External, internal, external. That is the heartbeat of the market.
It's constantly expanding and contracting.
Seeking fuel, rebalancing. Seeking fuel, rebalancing over and over and over again. And if you know where you are in that cycle, you have a pretty good idea of the next probable destination.
All right. We have the philosophy, the time, and the targets. Now, I want to get into really specific stuff. The 2022 model. This is the actionable part, the recipe. The source material breaks this down into very clear steps. Let's walk through a hypothetical trade from the moment we sit down at the computer.
Okay.
Step 1, context. The daily bias.
This is completely non-negotiable. Before you even dream of looking at your 5-minute chart or your 1-minute chart, you have to look at the daily chart. You have to ask the question, where is the daily candle trying to go today?
It's the old saying, don't swim against the current.
Exactly. If the daily chart is clearly bearish, meaning we just swept a major daily high and we're starting to head lower, you have no business looking for long trades on the 5-minute chart. You are hunting for shorts and only shorts.
How do we determine the bias, though? That seems like it could be the hardest part. The chart can look bullish and bearish at the same time, depending on how you squint at it.
Keep it simple. Look at the most recent major liquidity sweep on the daily chart. Did we just take out a major swing low from last week? If we did, then we've likely collected that sell-side liquidity, and now the algorithm probably wants to retrace higher toward a daily swing high or an old fair value gap. It's about seeing which side of the market was just attacked. The daily chart tells you the ultimate destination. The lower time frames just manage the journey to get there.
Okay, so let's run with an example. Let's say our daily bias is bearish. We expect price to go down today. We zoom into our bellwether time frames, the 15-minute or the 5-minute chart. Now we're at step 2, the raid.
Right. Since we are bearish, we want to sell. But we don't just sell at the market open. We have to wait. We need the trap to be set first. We wait for price to run up above an old, obvious short-term high within our kill zone.
So even though we're bearish, we're waiting for a move up.
We are waiting for the liquidity grab, yes. We need that turtle soup, as it's called. We need price to pop up, grab the buy stops that are resting above a recent high, and trade into what we'd call a premium. This is the hardest part psychologically for new traders because price is going UP, it looks strong, you're seeing big green candles, you feel that FOMO, that fear of missing out, but you have to sit on your hands.
Because without this raid,
there is no trade. We need that injection of buy-side liquidity to fuel the real move down.
Okay, so the raid happens, price spikes up, takes out the high. Everyone on Twitter is screaming, buy! But we are patiently watching for the turn. This brings us to step 3. The market structure shift. The MSS.
This is critical. A lot of people see the raid happen and they just blindly short the market. That's so dangerous. That's catching a falling knife. Or, I guess in this case, it's stepping in front of a rocket ship. You need confirmation that the raid is over and the reversal is actually starting.
So what does that confirmation look like on the chart?
It looks like a market structure shift. You need price to crash down and break a short-term swing point in the opposite direction. So if we just swept a high, we now want to see price crash down and break a recent swing low. But, and this is the absolute most important part, it can't just drift down. It needs to move with displacement.
Displacement. I love the description of this in the notes. It's not just a move, it's an energetic move. It has VVM.
Volume, velocity, momentum. You want to see thick-bodied candles. You want to see the market showing its hand. It should look like someone just slammed the sell button with conviction. It has to leave a footprint. If the move down is weak and choppy and wimpy, it's not real displacement, and the trade is invalid.
And that footprint leads us directly to step 4, the fair value gap.
Exactly right. When price displaces that aggressively, it moves so fast that it creates an imbalance. It creates a fair value gap or an FVG.
Let's get technical for a second here. I want listeners to be able to spot this. What does a fair value gap actually look like on the chart?
It's a simple 3-candle formation. So let's stick with our bearish example where we're crashing down. You have candle 1, a big down candle, candle 2, the huge displacement candle, and candle 3, continuation candle. The gap itself is the empty space between the low wick of candle 1 and the high wick of candle 3.
So candle 2's body is essentially sitting in an empty space between the wicks of the candles on either side of it.
That's it. It means price moved so fast through that area that there was no matching buy-side delivery to intersect with all the sell-side pressure. It was all one-sided. The market is unbalanced there, and because the algorithm seeks to rebalance, we have a very high probability expectation that price will gravitate back up into that gap.
And that is our entry, step 5.
That is our optimal trade entry. You place the limit order to sell inside that fair value gap. You don't chase the displacement as it's crashing down. You wait for price to take a breath. You wait for it to retrace back up into that gap.
This requires an incredible amount of patience. You see the price crashing, your bias is confirmed, you just want to jump in. But you have to wait for it to come back up towards you.
You have to wait. If it runs away without you, so be it. It runs away. You let it go. There will be another bus. But if it does come back, this is where you can use that premium versus discount concept again on a smaller scale. You take a Fibonacci tool, you drag it from the high of the Judas Swing down to the low of the displacement leg. You only want to sell if that retracement gets up into the premium above the 50% equilibrium mark. If your FVG is in the premium, that's your A+ high probability kill shot.
Okay, so you place the limit order in the gap. Where does the stop loss go?
Strictly above the high that caused the sweep, the high of the raid. No exceptions. If price goes back above that high, the entire narrative is broken. You were wrong. You get out, you don't pray, you don't hope, you don't move the stop, you just accept the loss and move on.
And the take profit target.
The opposing liquidity pool, the low-hanging fruit. If you are selling, you are aiming for the nearest clear swing low where you know the sell stops are resting. You don't need to aim for the moon. You aim for the next pool of liquidity.
It's a very structured, very logical sequence. Daily bias, daily kill zone, liquidity sweep displacement, creating an MSS FVG, entering hell.
Yeah.
Target, opposing liquidity. It's a complete story.
It is. It's a story the market tells every single day in every single session. You just have to learn how to read the language.
But it's not always that clean and perfect, is it? Step 5 in our outline here is nuance and risk management. Because I can hear listeners thinking, okay, this is a recipe, I'll just build a bot to trade this.
And that's where you get burned because of the phrase, one framework, many executions. This is a framework for your thinking, not a rigid mechanical robot. You still have to feel the market conditions. You have to use your discretion. Is the displacement strong enough? Is the fair value gap too big or too small?
The sources mention a specific setup called the silver bullet. Is that a different model, or is it part of this?
It relies on the exact same mechanics, the sweep, the MSS, the FEG, but it's highly time-specific. The silver bullet is basically looking for this exact setup to occur within a very specific 60-minute window, like from 10:000 a.m. to 11:000 a.m. Eastern. It's for people who want a very specific, defined routine. I sit down for this 1 hour. If the setup forms, I take it. If not, I'm done for the day and I go do something else. It's a great way to prevent overtrading.
I like that. It reduces the paralysis of staring at the chart all day. What about SMT divergence?
Yeah.
This is listed as a pro tip for getting extra confirmation.
SMT is incredibly powerful. It stands for Smart Money Tool. It's all about comparing correlated assets. Let's take the S&P 500 and the NASDAQ. They almost always move together, right? Like two runners jogging side by side.
Yeah, for the most part. If tech is having a good day, the general market usually is too.
Correct. So imagine we're in our kill zone. We're looking for a short. We see the S&P 500 make a higher high. It sweeps the buy-side liquidity. But then we look over at the NASDAQ chart, and at that same exact time, it fails to make a higher high. It actually makes a lower high.
Oh, wow. So that's a crack in the correlation. One is weaker than the other.
That is SMT divergence. It shows underlying weakness in the NASDAQ. It shows that the smart money isn't willing to push the NASDAQ higher. It's heavy. If you see that divergence happen at the exact same moment your 2022 model setup is forming on the S&P, that is high-octane confirmation. It's a massive clue that the reversal is imminent because the two major indices are out of sync.
Let's talk about the mindset, the psychology of this.
Hmm.
The notes mentioned being a sniper versus being a machine gunner.
A machine gunner just sprays and prays. They see a green candle, they buy. They see a red candle, they sell. They want to be in every single move. They're addicted to action. A sniper waits. They might lie in the grass for 3 days, or in our case, sit on their hands for 3 hours and take one perfect shot. In this framework, you are stalking the setup. You are not chasing price. You are letting price come to your predefined trap, that fair value gap.
And this ties into the idea of asymmetric risk, targeting these 2-to-1 or 3-to-1 payouts.
That is the math that saves you in this business. You do not need to be right 90% of the time. If you risk $100 to make $300, you can lose more often than you win and still be wildly profitable over time. The 2022 model is designed specifically to find these high R multiple setups because your stop is very tight just above the sweep, and your target is usually much further away at the opposing liquidity pool.
But you have to be willing to accept the losses when they happen.
Losses are just the cost of doing business. It's like owning a restaurant. You have to buy food